Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI webinar where we're going to be discussing a new exit strategy and exit strategy term, plus give you a sneak preview at a new BCI product called the Trade Management System, which includes our Trade Management Calculator. We believe the only product of its kind anywhere in the world. Let me give you a little background how this all came about, because this story started more than a year ago. First, let's talk about the trading log or the trade management system. Many of our members have been asking us about some kind of a product or tool where trades can be managed. In other words, we enter the trade, we adjust the trade via exit strategies, we get our initial calculations for the trades for our total portfolios, and then we get our final post-adjusted trades for each trade and for our total portfolios. Up to this point, we've been using certain tools like the daily covered call checkup spreadsheet, the Elite Plus calculator, the Elite calculator, Schedule Ds, and so on. But nothing that really started a trade from its very beginning and managed it through to the very end. Something where we could watch a trade from start to finish, get our final results, and then keep them archived either in some kind of a binder or some kind of a folder. Tonight, we will show you the sneak preview of this product, something that Barry Bergman and I have been working on for over a year now. The other aspect of this presentation is a new exit strategy and term that came about when more than a year ago, again, one of our members sent me an email. It went something like this. Alan, I mistakenly entered a covered call trade without looking at the next scheduled earnings report. As it turns out, that earnings report takes place prior to contract expiration. Do I have any other recourse other than closing out that trade? Well, I was glad that this member noticed the problem and knew it was important to avoid the report. I started typing. And I told him something that many of you have heard me say many times. If we do own a stock that's got an upcoming earnings report, we never write the call. We wait for the report to pass and then write the call if we're determined to hang on to that stock through the earnings report, or we just don't own the stock if we don't want to take the risk of a disappointing earnings report. So those were the two choices, but the position was already entered. So I told him that at the very least, you have to close out the short call. Or at least I told him that if he follows the BCI methodology, that's what he should do, and that's what I would do. Now, whether or not that stock is retained, that's something that depends on the confidence you have in that security. Then I started to tell him about if certain stocks have weekly options, that what you can do in those cases is you could sell options that contract month, just avoid the 1 week of the earnings report. That made me then go ahead and check to see if this particular security did have weekly options, and it did. So I continued typing. What you could do is close out the current expiration and then sell a new one, avoiding the earnings report prior to the earnings report date. And as I'm typing, I'm saying, well, what exactly is he doing here? He's rolling the option, but he's not rolling the option up. He's not rolling it down. He's not rolling it out, nor is he rolling it out and up or out and down. He's rolling it in. And as I'm typing that, I'm thinking to myself, I don't think I've ever heard that term before. And I've been doing this for 25 years. So what do you do when you want to see if something exists in society today? You Google it. So I Googled rolling in. Best I could come up with It's a couple of words in a song sung by Adele. Well, that didn't interest me, although she's a great singer. It's also the first two words in the term rolling in dough. Well, that doesn't apply here either. So I said, could it be that this term has never been used before? So I called up some contacts I have at the Options Industry Council, and I asked them, have you ever heard or used the term rolling in for exit strategies? And there was silence. And they asked me, when would you use that? Why would you use it? How would you use it? So I explained to him things that you will see in this webinar presentation. And after another moment of silence, they told me, Alan, you're onto something. That was about a year ago. So I knew that there was a need to incorporate this exit strategy into our arsenal, while at the same time, we're working on this trade management system, which is a trading log where we enter, manage, and get results of our trades. So for the last over a year now, we've been working on this new tool, incorporating this new exit strategy into our arsenal. You're going to be seeing some real life trades, and they are not specific recommendations. Folks, I hate this slide as much as you do, but we have to put it here. So take these particular specific trades for informational and educational purposes only. What are exit strategies? Well, these are trade adjustments. We enter a trade, and then there are opportunities that come about, not always, but they do come about relatively frequently, where we can manage our trades. And we make adjustments. We do so to mitigate losses, or in some cases to turn losses into gains, or in some cases to enhance gains to even higher levels. That's what exit strategies do for us. And they all begin the very same way, by buying back the initial short call or put. Now, we talked about rolling in. Let's talk about rolling in general. What is rolling an option? Well, that's where we buy back the initial short call or put and sell another option. We could roll to the same or different strike price. We could roll to the same or different expiration date. And when we roll an option, it can result in a credit or a debit. Let's define the various rolling terms. Rolling up is when we close out an option at a lower strike and open an option at a higher strike in the same contract cycle, month or week. Rolling down, we close an option at one strike price and open a new one at a lower strike price, once again in the same contract cycle. We can roll out or forward, and that's where we close out an option at a near-term expiration and open a new one at the same strike at a later date. That's rolling out. Now you could combine rolling out with rolling up and rolling down. In the BCI methodology, we rarely will roll out and down with our covered call trades. If we do roll out, it's rolling out and up. Now let's get to the new term, rolling in. And that's where we close out an option at the current term expiration and open usually the same strike at an earlier date. Now, it can be combined with rolling up and rolling down, but normally it's the same strike, because the purpose of this particular exit strategy is to avoid a risky event, whether it's an earnings report or a Fed announcement or a political event, or for medical reasons, we're avoiding a risky event. So let's talk about some of these rolling in applications. And let's start with avoiding risky corporate or market events. Earnings reports is what caused this whole webinar, trying to avoid an earnings report. But Fed announcements are critical. In early 2022, when I'm making this webinar, a lot of talk about in March whether the Fed is going to raise interest rates 25 basis points, 50 basis points, more. could affect the market in a big way. We may want to take any trades that we have expirations after that announcement and roll them in. How about an FDA product announcement, whether it's going to be approved or declined? What about a corporate news conference that's announced? We're not sure what they're going to say. We don't want to take the chance. We may want to roll that option expiration date in. Political events, Brexit, presidential elections. There's a lot of political news every day. And that doesn't mean we have to roll our options in all the time. But on mega events, which may affect the market in a big way, we may be inclined to do so. What about personal and business commitments, where we may not be available to monitor our trades? Family vacations, business trips. Maybe we're going to be in the hospital for a few days. So there may be some medical reasons why we want to roll our options in. We want to have that tool available in our arsenal should these situations arise. What if we have to liquidate our positions for a particular reason? We need the cash by a particular date. We're buying a new house. We need the cash to put down on the closing date. Well, we may have to roll those options in so we can then convert our positions to cash. So these are some of the reasons why we may want to take advantage of this rolling in exit strategy. Now, I'm going to turn in the next few slides to an overview of our BCI Trade Management Calculator, which is part of the trade management system. There are 4 sections per strategy. So 4 sections for covered call writing and 4 sections for selling cash secured puts. These 4 bullets, and the 5th one we'll talk about printing them out, will break down these 4 sections. So in the first section, we enter our initial trades. And this section, the first 2 bullets are based on the Elite Plus calculator that I'm sure many of you already have. So we enter our initial trades. And then in the second section, we get the initial calculations, as well as the exit strategy guidelines. And then those are calculated per trade and for the total portfolio, as you will see shortly. That's section 2. Now, section 3 of the spreadsheet is where we make our trade adjustment entries. And once again, there'll be 10 choices for covered call writing and another 10 for selling cash secured puts. That is section 3. Section 4 is where we get our final post-adjusted calculations. Again, per trade and for the total portfolio. Those are the 4 sections. Now, we've designed this product so that when you print it out, it will print out in those 4 sections. So if you save or archive your trades over the course of a year, you'll be able to put it into a binder or a file of some kind, and you'll be able to view your trades start to finish, both in terms of learning from our mistakes or learning from things that we did quite well and we want to keep on repeating. So it could be a learning tool, but it's also a way of monitoring and then archiving our trade results start to finish. Now, here is a screenshot of our trade management system and where you find the tab for the calculator itself, where that red arrow is at the bottom of the screenshot. Now, there are 4 additional tabs. You could see to the right of the arrow is our user guide, which is going to be, you're going to also receive in PDF format somewhere between 25 and 30 pages. So you'll have an opportunity to have the user guide both inherent in the spreadsheet as well as a separate PDF file. And the other 3 tabs we'll get to a little bit later on are worksheets you could use before making entries into the actual trade management calculator. Now, we enter our initial trades into the blue cells you see on the left side of the screenshot from stock symbol to number of shares. All that is entered into the spreadsheet. I highlighted in green MNO, the initial trade entry date, the expiration date. The price of the stock was 48. We sold the in-the-money 45 call for $5, and it was 100 shares. So that's when you make your initial trade entry into those blue cells. Now, the second section, which is where we get our initial calculations and exit strategy guidelines. So you could see that the spreadsheet will then tell us that there are 54 days in the trade, including the day of the trade entry to expiration, Friday. It will break down the time value and intrinsic value components if it's an in-the-money strike, any upside potential if we sold and added the money strike, the break-even price point, our time value return on the option, 4.4% in this case, the annualized return based on 54 days in the trade. Spreadsheet will do that for us, 29% in this case. Upside potential, of course, is zero when we do in the money strikes, but we do have downside protection of 6.3%, and that's the intrinsic value protecting the time value. So it tells us initially that we're guaranteed a 4.4% 54-day return as long as share value does not decline by 6.3% by expiration. It will also tell us that we generated $200 per contract of cash with this trade, and our cash outlay is $4,500 after deducting the intrinsic value from the cost of the shares. And then the three columns all the way to the right give us our exit strategy guidelines. Beyond the scope of this presentation to review those, but most of you are familiar with the 20%, 10% guidelines for covered call writing, as well as the 7% stock exit guideline. That is section 2. Now, below section 2, and included in that when you print it out, would be the initial total portfolio returns. So for the total portfolio that month or that week, how many contracts did we sell? What was the initial time value cash return for all of the positions in our portfolio for that cycle? What is the total potential upside? What is the total when you combine time value and upside? How much capital is invested? And then what would be the flat return without upside? And then the combined return with upside. That's all generated in section 2 of the spreadsheet. Now let's move on to section 3, which is we actually make our adjustments where we have the exit strategy selected, and the stock symbol will transfer over from sections 1 and 2. And then the exit strategy selected, so this smaller red arrow on the top, you'll highlight a cell and just click on that drop-down arrow, and it will give you the 10 exit strategy choices. You'll have different exit strategy choices, some the same, but some different for selling puts. And you just click on the one that you want to use. And you see MNO, we're going to use rolling in. So that's in section 3 where we make our adjustments. And then you just fill in the adjustment information. You know, what's the adjusted trade date? What's the buy to close on the original? What's the sell to open premium on the new roll-in date? We're using the same strike. What's the final value of the stock at the end of the trade? And then it will give you your net option information. So we're going to fill in those cells. Here's a closer look at the cells that you fill in. Okay, from trade adjustment to final unsold stock price. Sometimes the stock is sold, sometimes we still retain it. So that information is all put in the adjustment section 3. And then we get our final results in section 4 of the spreadsheet. And in this particular case, you could see that the final option result was 9.38% after the adjustments. Now on the stock side, since we bought the stock at 48 and sold it at 45, we actually lost 6.25%. Spreadsheet gives us that information. And then the last two columns on the right gives us our combined trade. So the net cash profit for the trade for the 100 shares was $150 profit, which resulted in a 3.13% return for that period of time. And once again, if you scroll down section 4 to the bottom, it will give you your final portfolio returns in terms of number of contracts, cash, net cash gain or loss. In this case, it was a gain of 23.30. Final realized stock profit, in this case, plus 800. Final unrealized stock profit or loss, in this case, we lost 156. And our net portfolio cash position was plus 29.74, which represented a return of 5.86% based on our cash investment. And that's in section 4 of the spreadsheet. Now, if you scroll down to the bottom of the spreadsheet in the second half, this bottom half, you'll be able to have the same opportunities, the same drop down for selling cash secured puts. So some of the strategies are the same, like rolling the options, but others will be different, like the 3% exit, the 10%, 20% exit strategies are different. They're for share appreciation. That's all in our material. But again, 10 opportunities for covered call writing and 10 for selling cash secured puts. Now, I wanted to show you, in addition to the calculator and the user guide, we have worksheets, one for rolling in, which could be used both for covered call writing and puts, the Unwind Now tab for closing both legs of a covered call trade, and the What Now tab for rolling covered call trade. So those worksheets are available and attached in our trade management system if you're inclined to use these worksheets before entering into the actual trade management calculator. So here's a real life example with Etsy. It shows opening a covered call trade. Now, folks, what you're looking at here now is the rolling in worksheet tab, not the actual calculator. And it shows you trade entry dates of 2/15, the price of Etsy at that time, the strike price. We're using different strikes with different expirations. And we don't have to go into the details of these, but it will show you your actual time value return for the shorter and longer term expirations. And then it will give you your initial annualized returns for the two shorter term and longer term. So that's on one side of the worksheet. Now we use our rolling in exit strategy. We roll in to a nearer term expiration. So we enter our buy to close, the new expiration date, the sell to open on the new expiration date, and that's always going to be less because there's less time value for a nearer term expiration. And the spreadsheet will then give you your time value return, your annualized return, and it will tell you what the difference is between the initial and the rolled in exit strategy returns. In this case, the annualized return difference is higher. And that's because it won't always be higher, but in this case it is. And when it's higher, that's usually because you're investing your money in a shorter time frame. So frequently the rolling in will result in a higher annualized return, but not always. So let's summarize this Etsy trade before we do a couple more. These four examples all show an actual increase in annualized returns, but the main point here is we're avoiding a risky event. Now, we also happen to be enhancing our portfolio returns, but the most important thing is avoiding the event. Once again, not all rolling in maneuvers will result in an increase in annualized returns, but all will avoid the high risk event. Here's an example with an ETF, Invesco QQQ Trust. These include 100 of the largest non-financial companies that trade on the NASDAQ exchange. And you could see here that we're using 319 and 618 expirations with a trade entered on 2/15. So one has 33 days to expiration and the other 124. Just want to show you different time frames. And it will tell us initially that our time value return runs between 2 and 5%, and the annualized runs between 15 and 23%. Now we enter our buy to close. On the original sale, our rolling in shorter term expiration date, we use two different ones. Our sell to open premium, Let's go to the right side of the spreadsheet now, and it shows us that our actual return is still significant, anywhere from 1.6% to 2.07%. And it gives you your annualized returns. What's the difference annualized wise? Well, in one case, it's slightly lower. In one case, it's pretty similar. And in another case, it's actually a greater return for the longer term. By rolling in to a much, much nearer term, we're going to end up with a higher annualized return. We already knew that. Shorter term options generate higher annualized returns in many cases, even if we're incorporating a buy to close debit. Now, here's an example with Apple. And Apple at the time was trading at 135.38. This was in 21. We're going to use the 140 and 130 strike prices with the same expiration dates of 5/21. And you can see that we're having a time value return in the 5% range, annualized out into the 20% range. We're going to roll in now to a nearer term option. We used 4/16 and 3/19 just to show different expirations, and the buy to close premiums and the sell to open, which are going to be less because of the shorter time frame. And we go to the right side of the spreadsheet now, and we see that the time value return on the roll-in trades ranges from 1.7% to 3.2%. And the annualized return difference is very close, slightly less from rolling in of 1% annualized to 0.5% annualized. Almost negligible, but slightly lower in these four cases. So once again, it shows us that in some cases, the difference in the annualized returns will be a little less, sometimes a little more, but in all cases, we avoid that risky event. Here's real-life examples with 4 select sector spiders taken from a recent ETF report in early 2022. And you can see that the initial time value returns ranged from what our target goal usually is with ETFs, between 1% and 3%. And the annualized returns went from 17 to 41%. So pretty significant returns with these select sector spider ETFs. Now we do our buy to close. We roll in the dates a week earlier, and we put our sell to open premiums, which are going to always be a little bit less, and the number of days in the rolling trade. And now we go and see what are our time value returns on this new trade. Once again, it's from 1% to about 1.5%, a little bit less. And the annualized returns run from 21% to 29%. In one case, an annualized loss of 11%, one case a gain of 4.5%, and one case a gain of 7%. But the actual returns are still significant. And remember, even though the annualized returns could be less, we still have an additional time to use that cash from the new rolled in expiration to the original. And if we can't use that particular security because of some kind of event, then we can do a different type of investment to generate additional profits. In any case, sometimes it's a loss annualized, sometimes it's a gain, but we're always avoiding the risky event. So, to summarize this, ladies and gentlemen, rolling in is a new and additional position management technique that can be utilized to avoid risky events and allow us a better management, how better manage our positions. The cost to roll in will typically be low or frequently result in a higher return because of the shorter time frame. Now, we can take this time frame then, the shorter time frame, to reinvest that cash. The BCI Trade Management System is a unique tool, I believe, the only one of its kind anywhere, and will assist us in managing our rolling in trades as long as all the other exit strategies for both covered call writing and selling cash secured puts. And it's an amazing learning tool as well, because we can go back and review our trades start to finish. What did we do that we could have improved upon? What did we do that we really liked and we should continue to do? And this not only will manage our trades, give us an opportunity to see how we're doing, how we're progressing, but also provide us with an amazing learning tool. Now, for those of you that are looking forward to this tool, which will be available by the end of March 2022, make sure you're on our mailing list. Most of you are already, but if you're not, go to our website, thebluecollarinvestor.com, click on the blog link, scroll down on the right side, and subscribe to our free newsletter. That will get you on our mailing list. And we're also going to be sending out an early order discount coupon. So to make sure you get that, make sure you are on our mailing list. Ladies and gentlemen, I consider this one of the most important webinars ever presented by the Blue Collar Investor. My hope is that not only you enjoyed this presentation, but my hope is that you benefit from it in the long term, because having another exit strategy in our arsenal is important. And having this trading log, this trade management system, which includes the trade management calculator, will allow us to enter, manage, and get final results, and also serve as an amazing learning tool. So I hope you benefit from it. Thank you all for attending this presentation. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.